Hi, I'm Rainey with Finance Strategists. In this lesson, we're going to cover
Valuation is a process by which analysts determine the present or expected worth of a stock, company, or asset. The purpose of valuation is to appraise a security and compare the calculated value to the current market price in order to find wise investments. While the current market price is said to reflect all variables, including irrational behavior, valuation models will only factor in a few variables. This is why there are so many different methods of valuation. Valuation is related to fundamental analysis, which attempts to analyze the fundamental drivers of a security. To arrive at a valuation, fundamental analysis looks at a broad spectrum of driving factors such as the financial metrics showing the health of a business to outside variables such as public policy, like the federal interest rate. This stands in contrast with technical analysis, which analyzes statistical trends of trading activity such as changes in price and volume. Among the many methods, three of the most common models for determining the value of a company or asset are the dividend discount model, the discounted cash flow model, and the capital asset pricing model. There are two categories of valuation: absolute valuation and relative valuation. Absolute valuation considers company fundamentals like dividends and cash flow to establish the intrinsic value of a company. The models mentioned earlier are examples of absolute valuation. Relative valuation compares a company with other similar companies to determine a relative value. Analysts compare metrics like the PE multiple to determine whether a company is better or worse relative to competitors. This method of valuation is usually easier than absolute valuation, so analysts and investors often start with relative valuation first.
For more information, visit www.financestrategists.com. Finance Strategists, strategies for your future.